Hello, I'm Dustin Padgett with Sioux Wealth Management. And as if you aren't sick enough of hearing about the election, we will continue to add fuel to the fire. Now is an excellent opportunity to look at how the markets might react to a Trump versus Biden presidency. Specifically, in the attached newsletter, we get into more detail regarding some of the broader themes concerning the candidates' different approaches that might impact your portfolio. There are a few key areas where Biden and Trump differ significantly. This newsletter will prepare you with several possible outcomes, each with different implications for policy, the economy, and the financial markets. We feel there are 4 potential outcomes to consider. We evaluate these potential outcomes from an economic perspective, noting that the main difference between a Trump and Biden presidency will center on taxes, fiscal policy, regulation, and dealing with China trade. Number 1, status quo. Republicans retain control of the White House and Senate. This outcome would likely cause the least amount of change from the prior 4 years. This outcome would likely be viewed positively by the equity markets, and the current market trends would continue. Number 2, Biden presidency with split Congress. This is the least discussed electoral outcome, but according to Barron's, a split government of this sort might be the best for the markets. Investors may benefit from Biden's more predictable trade policy and a continuation of Trump's tax policy. Number 3, a Democratic sweep. This would be the biggest change from the past 4 years, so keep our focus on how this might impact the economy and the financial markets. Many assume this so-called blue wave will lead to a reversal of policies put in place by Trump, such as broad deregulation or even the repeal of the Tax Cuts and Jobs Act of 2017. For markets, this outcome will likely mean higher federal taxes for corporations. We have included a summary of the proposed changes in the newsletter. While higher tax rates would lower earnings, J.P. Morgan lays out a case where those lowered corporate earnings could be almost offset by an increase in earnings from potential de-escalation of trade tensions with China and a possibly larger infrastructure plan. Number 4, contested election. We know markets do not like uncertainty, and regardless of who is declared the winner, supporters of the opposition may view the president as illegitimate. Wealth Advisor notes the worst outcome for the stock market is a delayed or disputed election results. Ultimately, we expect that a contested election, along with social unrest, will be a recipe for market volatility. We are currently encouraging investors to prepare themselves for this scenario. Remember that being ready does not always necessitate action. Oftentimes, we feel the best decision in the face of volatility is to hold steady. Over the past 120 years, the long-term performance of the markets has shown almost no correlation with government policies. Brian Levitt from Invesco says instead, the key drivers of stock market performance have been earnings and economic growth. Other factors like the decisions made by the U.S. Federal Reserve have a much greater impact on market sentiment than any soundbite we hear from politicians. Regardless of the election victor, Tom Lee, head of Fundstrat Global, believes there will be further stimulus. The virus will probably be contained in mid-2021, and the U.S. economy will be accelerating. Nobody can predict who will win, what the outcome will even mean for the markets. One thing we are certain of is that we should not allow the election predictions and outcomes to influence our investment decisions. As we laid out in our previous newsletter, history has shown that election results had very little impact on long-term returns. Expect volatility, but don't fear it. We would view any potential pullback surrounding the election as a buying opportunity. The next several weeks will be a challenging time for investor psychology. Our hope is through putting the election in historical context, as well as discussing the potential outcomes beforehand, you will be prepared to face the election volatility with confidence, not fear. As always, we appreciate your business and hope you enjoy the newsletter.